Discuss this quarter gone by and the outlook going ahead. We're joined by Chander Aagrwal, who's the managing director of TCIExpress, who joins in on the show. Chander, good morning, and as always, great having you on the show. It was a good quarter. I mean, there was a very high-cost operating environment, but despite that, you managed to sort of hold on to your margins. Just wanted to start by asking you about what the growth target is for the full year, because earlier, if I'm not wrong, you had a growth target of 18 to 20%. Do you hold on to that? Do you think you can do better than that after what you've seen in the first half?
Right. Thank you. I think 18 to 20% is achievable. And, unless there's like a really, dynamic event that happens and the economy is doing really well, then we could see a further uptake. I don't think that's going to happen. So 18 to 20% is definitely which is happening.
Okay,
Hi, morning, and thanks so much for joining in. So you are guiding for an 18% revenue growth for the full year, right? Holding on to that. Okay. A couple of weeks ago, another player in the logistics space, Delivery, kind of spoke the markets when they guided for a weaker than expected, growth. They spoke about the festive season not being as strong as perhaps what the street would have anticipated. I understand that the business models are not strictly comparable, but could you throw some light on what's happening on that front and what your capacity utilization was this quarter and what it could trend?
So that company is essentially only B2C, right?
Yes.
And we are only doing B2B. And the real growth, what everyone talks about is the growth in the business B2B aspect. And the B2C is something which is again driven by high interest rates and all of that, the consumer demand. So I think that's why they would probably have given a very poor guidance. See, our business is it goes on the growth rider is GDP growth of a country. And here, if you're looking at 7 to 8%, definitely we're looking at about 16 to 20% top line growth, which would mean that we have at least 30% bottom line growth. So we are in line with our guidance given previously, and and we don't intend to be in the B2C space at all.
All right, so you're in line with the previous guidance. Chander, good morning and thanks for joining us. Could you tell us where you see the margin trending? I mean, right now you've been able to maintain it. It's completely flat at 16.6 in spite of high operating costs. But with those coming down, could you see a significant improvement in margins in the coming quarters?
Yes, Q1 we were at about 14%, and then we now in Q2 we're up to almost 17.
Yeah.
And I think Q3 and Q4 we would possibly be in the high 17 plus. So I think high 17s. So this is definitely also because the business model is as such that we keep getting incremental business growth and profit growth.
Okay. Can you, give us a little bit of a bird's eye view on how things are going to shape up from here on over the next 1 to 2 years? Where do you see the large amount of demand come through from? I mean, you do have about 8 to 9% of your revenues that comes from the auto sector, and we're seeing so much demand there. But tell us, across the verticals that you cater to, where do you see maximum demand over the next 1 to 2 years?
So we are working in the high value segments of the economy, and the auto sector is the auto components, which are replacement products. And so even if your car doesn't sell, the auto components, they are moving for as spare parts. So that's in line with whether there's a lockdown or no lockdown or anything like that that comes along. And also the pharmaceuticals is the same, which is, always evergreen, keeps going. And we have the engineering products, textiles. So all the high value items, barring like commodities and, or B2C for that matter, we are in line with the growth with the GDP.
You've given us a capex target of 500 crore between 2023 to 2027. Would this be front loaded? what is the overall amount of production or the amount that you will be able to add in terms of revenues on account of this capex? And if you could just give us a breakup, how much in 2023, 2024?
So we would be investing about almost 100 crores, 120 crores every year. And this is all going into the sorting centers and automation, expansion of the sorting centers and automation. And it's all through internal accruals. There's no debt. So we would imagine that in the next 5 years, we also want to double our revenue. So, I mean, this investment necessarily doesn't go for doubling the revenue alone, but it helps in kind of like creating an ease of operations for the next decade also.
Okay, got that. You had mentioned that you opened 22 new branches during the first half, and you're also looking to add more, right, in the second half. So can you tell us what the revenue from just this part could be?
So it's incremental. It happens like, depending on what the situation is in terms of, where they're being opened on the ground. And they're all part of the growth that we have laid out for the year. So all the growth entails the branch expansion and, all the investments that we do.
What about Rail Express? You did mention earlier that your customers over there have gone up from 250 to 1,000. Can you tell us, as a revenue contributor, how much do you think would come from that vertical, and what is the target over the next 1 to 2 years?
Well, I can tell you that for the next 5 years, it'll be about 25% of our top line. And it's actually a very profitable business for us because, we don't use the rail, the cargo segment of the Indian Railways. We use the passenger side. It's a very unique business model. And this way, the main idea is that we're operating out of only just maybe 100 or 150 offices. And the idea is to start using this service, or rather providing this service in the next 800 offices that we have.
Chander, you said that this capex that you will be making over the next couple of years will be for sorting centers and automation. Now, this should boost your margins, right? So 17% margins today. But as you start automating more, investing more in sorting centers, what could your margins improve to, say, 5 years down the line?
That's a great question. The 17 to... So my target is that in the next 3 years, we take the 17 to 20%. And when automation kicks in, and various centers, maybe like across 6 to 7 or maybe 7 to 10 centers, I can imagine also that our margins can go up to 23, 24%. So that's post-automation pan-India is something that we can definitely, we will be targeting.
But when will that kick in? When do you think your automation will be completed so you can start enjoying margins of 22, 23%?
Well, target is to, get it done maximum in 4 years, all through India, yeah.
Okay, that's a big target that you have. All the best with that, and thanks a lot for joining in, Chander. Have a great second half of the year.